All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world, and happy Friday, everybody. Today is August 7th, 2026, and our top story this morning is the jobs report. It was bad. How bad was it, you should ask? Well, it's funny you should ask. It was really bad. And don't let the headline number fool you. The headline number, it was negative, but it was so much worse than that. And don't let the downward revisions fool you. The downward revisions were bad, but it was so much worse than that. It's really in the demographic data. When you look, you realize just how dreadful and, dare I say, hopeless the situation is for job seekers out there. Remember all those college kids booing at the commencement addresses when some muckety-muck would mention AI? Yeah, you understand why those kids are so pissed right now. They are graduating and aging into a job market that just absolutely sucks. So let's talk about what's going on in the job market. The July non-farm payrolls report, negative 20,000 jobs added for the month of July. The market was expecting a gain of 80,000. That's a big miss there. But wait, there's more. Downward revisions to the June numbers, downwardly revised by 66,000 from 129 to 63,000 jobs added. I told you last month that the June jobs number, it was good. It was too good. Maybe you could explain some of it with FIFA, but I expected big downward revisions in subsequent months. You got your big downward revisions in subsequent months. But wait, there's more. May downwardly revised by 37,000 from 57K down to 20K. The 2 months combined, 103,000 lost in downward revisions. When you add the 23,000 headline number lost to that, you've got a net loss of 126,000 jobs for the month of July. Guys, that sucks. That really sucks. And you'll see when we'll get into the charts and the attachments, we had a loss of full-time jobs, a gain of part-time jobs. All right, so the jobs that are out there are low quality. We had a gain in multiple job holders, so people have to work more jobs just to make ends meet. A whole bunch of BS gig work was added in the month. And then when you actually look at what's going on in the population demographics, you realize it's even worse than that, because we have had hundreds of thousands of foreign-born workers left the economy, either voluntarily or through deportations, the big crackdown on immigration. So that means the workforce shrinking, and yet that is still masking what's going on in the jobs report, because when people are leaving the workforce due to deportations, you should have unemployment falling quickly. And unemployment did tick down, but it didn't tick down because of people leaving the country. It ticked down because of people giving up. And you can see that in the demographics of the native-born people, the people who were born in this country. And we don't have like accurate citizen versus non-citizen data in the non-farm payroll, so we have to kind of just go by native-born and foreign-born, which is a pretty close proximity, facsimile, if you will, to immigrant versus native-born citizens. It's really bad. People are just giving up. You can see it with the unemployment rate. Oh, hey, it dropped. The unemployment went from 4.1 down from 4.2. All right, unemployment dropped. Oh, that's good. More people found work. No, they didn't find work. They quit. They just gave up. They dropped out of the labor force. Participation rate, 61.4%, down from 61.5%. So it's not that they found a job. We just don't count them as unemployed anymore because they just gave up trying. Over the last year, the participation rate has dropped from 62.2 down to 61.4. That's almost 1 million people just gave up looking for a job. They're still unemployed. They're still not doing anything, but they just stopped looking. And so we don't count them anymore to make the statistics look better. Really bad jobs report here. And look, if you're Kevin Warsh at the head at the Federal Reserve, and you're giving these tight-lipped press conferences where you refuse to answer certain questions, you don't want to give any foreign guidance, because you're claiming you want the market to react to the macroeconomic data, not react to what they think the Fed is going to do based on that macroeconomic data. If you're Kevin Warsh, you're disappointed today because we got dreadful news in the job market and stocks are up and the dollar is weaker and bond yields are lower. Why? Because everybody's saying, well, there goes your Fed rate hikes later this year. The market is pricing in less of a likelihood of a Fed rate hike, much to the chagrin of Kevin Warsh, who would prefer markets actually trade on how the economy is doing, silly rabbit, instead of what they think the central bank is going to do. Will they print or won't they print? Will they cut or won't they cut? Will they hike or not? All right, so as all of that is going on this morning, we have got some wild moves going on in metals. A lot of commodity stories today. First of all, gold and silver are ripping this morning. That's being helped by the jobs report. The jobs report set interest rates lower and the dollar weaker. So, of course, that is sending gold a little bit higher. But gold was already ripping this week. Gold has had a fantastic week. Silver right along there with it. We got a story about China's central bank bought 20 tons of gold in July. That's according to PBOC data, not the World Gold Council data, which was highly suspect recently. So we got the Chinese central bank is buying gold a lot in July. So that is certainly putting upward pressure on prices here. Now, we've also got the makings of a supply squeeze going on in copper. This is interesting. We talked about copper yesterday as well. Copper prices approaching all-time highs. The U.S. and China are both draining the London Metals Exchange. You got metal coming to the U.S. People are hoarding it here because they're afraid of a thing in tariffs. For whatever reason, the Chinese are also buying up copper. Maybe because they're worried about the U.S. having all the supply. I don't know. But you've got a supply shortage developing in copper, and so prices are moving to the upside. Now, Dr. Copper, typically that would be a bullish indicator. Hey, that's healthy macroeconomic data. But wait, why then is steel crashing in China? This is wild. The price of steel, in particular steel rebar, is hit a decade low in China because of the collapse in the construction industry in China. We talked about it at great length on this channel. The Chinese built too many damn buildings that nobody lives in, and so the price is crashing, and they've got a huge capacity problem, and the price of steel is plummeting. So you've got two metals that are very indicative of the overall health of the industrial economy, copper and steel, moving in two wildly different directions right now. Which one is right? I don't know. I'm leaning towards steel is giving the right signal right now because copper is going higher because of the biggest misallocation of capital in human history, the AI build out here in the United States where they're putting a ton of copper into data centers, and also because of worries about tariffs. Those are two extraneous market signals that I don't think are really based on any underlying fundamentals or actual legitimate demand. It's based on pretty much accounting fraud, a speculative asset bubble, and governments with their fingers on the scale, whereas steel is reacting to a grotesque excess of production over the last few years. I think steel is actually given the right signal here. But steel and copper going in two different directions. Somebody explain that to me, as if I was a golden retriever, please. Also, we're talking about a frozen housing market, about how, it sucks to graduate into this job market because there's just very few prospects for work. The work that is out there is bullshit. So we have a frozen jobs market. We've also got a frozen housing market. And that reared its ugly head. God, kids just can't catch a break. And when I say kids, I mean young adults. You're aging into a dreadful job market and the most expensive housing market in history. I don't know what to tell these kids. I really don't. Good luck to you, I guess. I don't know. United Wholesale Mortgage yesterday, one of the biggest private mortgage lenders in the country, their stock dropped by 35% in a day, the biggest decline in that company's short history, after posting a $452 million loss and suspending their dividend and announcing $2 billion is being pumped into the firm by Oaktree and the company's CEO even. So mortgage lenders posting gargantuan losses. Is it 2008 here? Do we have that? Well, look, we got data from Rocket Mortgage. They reported yesterday after the bell. Rocket Mortgage earnings weren't great either. They weren't nearly as terrible as UWM's were. But shout out to my friend Melody Wright, who helped me walk me through that one yesterday when I saw that United Wholesale Mortgage story. Guys, things in mortgage land not looking so good. And if I might recommend Miss Wright's Substack, because she has done a fantastic job documenting what's been going on behind the scenes in the mortgage industry, basically saying stories like this were coming. And, a lot of people gave her a lot of shit on Twitter, calling her a doomer and everything, something I wear the doomer badge proudly on my arm because the doomers will be vindicated. They've been right all along. Just accounting fraud has masked what's been going on in both AI and in the mortgage market. And I think we got a little hint of that yesterday with the UWM story. On the geopolitical front, we've got an interesting story. Turkey, Saudi Arabia, and Pakistan, all three of them have just signed a joint defense agreement. That's kind of wild. Signing a joint defense agreement with Saudi Arabia, who is currently under attack from two different countries. So Turkey and Pakistan just basically signed up for a war. Not really sure why. Like Pakistan, number one, nuclear armed, Sunni majority, and they're also supposed to be mediating talks between the U.S., Israel, and Iran. Well, if Pakistan is potentially getting roped into the conflict through joint defense agreements, it's kind of hard to act as a neutral mediator. So that's interesting. And then Saudi Arabia, obviously, they're right in the middle of all of this. Turkey, second biggest army in NATO, a NATO country, one of the biggest air forces in the world, a huge fleet of F-16s, one of the biggest drone producers in the world. Turkey getting involved. Turkey's also flexing its muscles in Syria, propping up the government there, which so far the government in Syria has kind of operated within bounds. But, hey, that guy in charge in Syria used to be Al-Qaeda. Oh, are they our friends now? I'm sorry. Is anybody keeping track of this shit? So are we going to have like a joint Pakistani, Saudi, Turkish army pushing into Yemen to try to contain the Houthis? I don't know. But keep an eye on that story. All three of those countries, Sunni majorities, by the way. And last but not least, we've got to talk about Japan. Shout out to my moderator, Mish. Found a story this morning. The four biggest insurance companies in Japan have combined posted $96 billion in unrealized paper losses on their Japanese government bond holdings just in this latest quarter. $96 billion in losses. That is a huge amount of money for these Japanese companies. It might seem small in the era of AI circular round tripping and financing of data centers, but that's a huge amount of money for the Japanese companies. And we've seen similar stories like this. Interest rates rising, causing big losses in bonds, hitting Japanese financial institutions. Actually, we saw a very similar story earlier last year involving a Japanese bank, and insurance companies are basically banks. So if the insurance companies are having the problems, the Japanese banks are certainly having that same problem. It just goes to show you what's going on with the yen and the big bailout in the yen that happened earlier this week, and the rising interest rates in Japan, the increasing cost of borrowing. All these stories are interrelated. There is some serious underlying weakness in the Japanese financial system right now, and it's showing in these lightly regulated insurance companies. And we've got some visuals and some historical context for that one at the end of the show. Lot going on today, guys. Let's shrink my big melon of a head and see what's going on in the world of finance. Don't forget that like button and that subscribe button for the YouTube algorithm so you can come back tomorrow and have your coffee with us melon heads, because we do this every day. All right now the S&P 500 is higher by 24 points or 0.32%, but you will notice, Kevin Warsh, are you being vindicated? Because we had that big rally on that dreadful jobs report. People were like, buy my stonks, man, because Fed no hike in December. And now people are like, maybe not so much. And they're selling the stocks that they bought 15 minutes ago, apparently. All right. Some interesting market reactions here. Initially up, now right back to where we are. So stocks essentially unchanged on a horrible jobs report. The Dow is higher by 83 points, 0.16% in the green. Same thing there, big pop after the jobs report. Now we're selling that rally off. And the NASDAQ doing the same thing, although the NASDAQ is hanging on to some of its gains here. 240 points higher, 0.82% in the green. So stocks are still up in all three indices. Now we have got the U.S. dollar is weaker, and those losses are holding even as people are selling the rally in stocks. We've got 99.49 on the Dixie. That's off by 45 basis points. This is the Forex market saying Fed less likely to hike later this year, given just how terrible that jobs report is. We still got some inflation data we got to get through before you count those particular chickens. But for this morning, at least, weaker dollar, sharply weaker dollar by 44 basis points. And we've got people are buying bonds. Little bit of risk-off behavior in the bond market this morning. The 30-year yield lower by almost 3 basis points, 5.185%. The 10-year yield down almost 5 basis points, 4.623%. The 2-year yield is off by nearly 7 points at 4.176. And the 1 month at 3.701, down by a half a point. Remember, guys, yields falling as bond prices rising. So you've got people are buying bonds this morning. Bitcoin is catching a bid off of that weak jobs report and reduced prospects for a Fed rate hike later this year. Currently higher by $922, $65,188 for Bitcoin this morning. And metals are having one heck of a morning. They are off the highs of the morning. So again, metals are giving up some of that prior enthusiasm, just like stocks are currently doing. Spot gold, $4,339. That's higher by 99 bucks, 2.37% in the green this morning. That's on top of the nice rip yesterday. We hit an intraday high of 43.71 for spot gold, and front month gold futures even cracked 4,400. Look at that. Gold is having just a hell of a run this week. Spot silver, 63.90. That's higher by $2.39, or about 3.9% higher this morning. We hit an intraday high of 65.14 for spot silver this morning. Again, giving up some of those gains as the market kind of wrestles with the math and the Fed prospects following that jobs report. But you know what? I like the shiny. Silver appears to have put in a bottom around 54. Caught a nice bounce from that level. We'll look at the gold chart in a little bit. Nice breakout from that decline we've been in since January. Copper, meanwhile, is down about 1.1% this morning. We'll talk about copper in a minute here as well. Platinum higher by 1.7%. Palladium higher by 1/3%. Crude oil is down about 54 cents a barrel, or 0.7%, sitting at 76.75 for September WTI futures. All right, guys, here's the jobs numbers. And not good. The U.S. economy unexpectedly shed 23,000 jobs in July, following a downwardly revised 20,000 gain in June, and compared to forecasts of an 80,000 increase. And again, guys, that June number, I don't know where they're getting a 20,000 gain in June. Is that really 20,000? Wow. The June numbers were really terrible. Big declines here. So again, 23,000 jobs lost in July, 103,000 combined in downward revisions to the two prior months. So your net gain, or your net loss, 126,000 jobs for the month of July. Not good here. Now, let's talk about some of the sectors and some of the specifics in the jobs report. We're going to scroll past a lot of this headline stuff. What category is it? In the establishment survey, this is where they call up employers and say, what's going on at your place, versus the household survey where they call up people and ask what's going on in your house. In July, employment declined in local government, education, and retail trade. That is where most of the job losses happened. Employment continued to trend up in healthcare. In particular, employment in local government education declined by 50,000 in July after showing little net change over the prior 12 months. And then retail trade lost 19,000 jobs in July. But it's that 50,000 teachers, 50,000 in local government education has declined. All right, so what's going on there? We've got a couple of things are going on in local government education. Number one, the crackdown on immigration. All right, we've had millions of people left the country, and a lot of them took their kids with them. So that means fewer kids into school. You've also got a growing trend since COVID of homeschooling, a significant growing trend of homeschooling. So on top of that, you've got population declines. We're just not having kids anymore. Why? Because you can't freaking afford it. Because of the damn money printing and the inflation and the K-shaped economy, people can't afford to have kids. And if they can't afford to have kids, they're not having kids. What does all that mean? You've got less demand for teachers because there's just fewer children. That kind of sucks. That's people with no future, people with no hope. When you have fewer kids, everything tends to start falling apart. 50,000 teachers leaving the workforce. That sucks right there, guys. All right, let's also talk about the unemployment rate, because you'd think with 126,000 jobs disappearing, you'd think unemployment would have gone up. No. Unemployment went down 4.1%, down from 4.2% in June. And go all the way back to November of last year, we were at 4.5%. Unemployment has actually fallen dramatically. Oh my God, it's the best economy ever. Everybody's working, right? Nope. That is not what's going on. It is just hopelessness. And you can see that in the chart of labor force participation rate, down to 61.4 from 61.5. It's not that those people found work. It's that we just don't count them anymore as unemployed because reasons. And again, go all the way back to November. We were 62.5 back in November of 2025, now less than 61.5. 0.1% is about what, 160,000 people. Guys, there's like 1 million people left the workforce over the last year. They just gave up. Okay, maybe half of that you could attribute to people retiring, like baby boomers aging out of the workforce, but not that many. This is young people just calling it quits. And guys, we can see it in some of this data. All right, this is, what table is this? This is table A7 in the jobs report. This is where they start to break out the demographic data. And you can see what's going on with that labor force participation rate. First of all, let's look at foreign-born 16 years and older. All right, the civilian population of people born outside the United States. And again, this isn't necessarily legal versus illegal. This is just people who are born outside the United States, but your illegal immigrant population falls within this category, among others. So you've got, a year ago, we had 48.5 million people, foreign-born people living in this country. Today, 48.1 million. So we have lost 401,000 foreign-born people in this country, right? That's your deportations, both voluntary and involuntary. And you can see it also in the labor force of that demographic. 31.5 million people in the workforce foreign-born versus 32 million a year ago. 550,000 foreign-born people have dropped out of the labor force. All right, that should be pushing unemployment lower. That should be pushing unemployment sharply lower when you don't count. You have fewer people bidding into the job market. But even as that happens, look at what's going on with the civilian, with the native-born population, which includes U.S. citizens. All right, the population is 227.1 million versus 225.2 a year ago. So you've had population growth of about 1.9 million people. That's native-born Americans. And then the workforce, though, this is the thing. Even though the population has grown, look at what the workforce has done. 139.5 million a year ago, 138.7 million this year. The native-born workforce has shrunk by 861,000 people over the last year. Even though there are 1.9 million more of us, there are 861,000 fewer of us working, and that's as 500,000 foreign-born people have left the country. So these numbers would be even worse. This jobs report would be even worse if we still had all those people who have recently left still here bidding their labor into the labor pool. So the situation, the demographics going on in the job market from the crackdown on immigration is hiding just how bad the job market really is. It's making it look a little bit better. It would be even worse if that wasn't going on. And then table A9 of the jobs report starts to talk about like what kind of jobs are actually out there. Full-time, part-time. Look at this. 133.5 million full-time jobs versus a month ago, 133.6 million. So we lost 106,000 full-time jobs in the last month. Those are your good jobs that come with your benefits and your paid time off and medical, all that stuff, retirement plans. And we replaced them with a bunch of BS part-time jobs. Part-time jobs, 28.7 million versus 28.6, a gain of 138,000 part-time jobs. So, people lost their job as a teacher and they got a job as a barista or a greeter at Walmart. All right, that's not economic prosperity. You can't live off of that. As a matter of fact, you typically need to get 2 jobs to make up for that teaching job that you lost. You got to work as a greeter and as a barista. And you can see that in the multiple job holders here. 8.69 million versus 8.55 a month ago. An extra 139,000 people now working 2 jobs or possibly even 3 jobs in the country. We have seen this trend for years. Losing full-time work, gaining part-time work, and gaining multiple job holders. And another trend we have seen for years is the rise of self-employed unincorporated. That is gig work, your Uber drivers, your Door Dashers, your OnlyFans girls. On top of that, you've also got day laborers, temporary farm help in this category. All right, we saw a gain of 309,000 self-employed unincorporated. So the kind of jobs that are out there are not the kind of jobs that most people want. The job market is really weak. We're producing fewer jobs. The jobs we are producing suck. And a lot of people are just out there giving up And this is as some of the, just how truly bad this is being hidden by the crackdown on immigration. All right, now we got to talk about metals, guys, because there's a lot going on in the metals market. First of all, this is the gold chart, daily candles going all the way back to February, and you will notice this downtrend, this brutal downtrend that my gold bugs went through over the last few months. I've been right there with you guys. It was nice to watch the price of metals rise. We know the FOMO went too far. We knew the correction was coming, and it was brutal. And it looks like we have broken out of that correction this week. We have had a really good couple of days in metals trading here. Let's hope it holds. So let's talk about what's going on in the gold market. We found this one this morning. China's central bank adds 20 tons to gold reserves in July. China's central bank ramped up additions to its gold reserves last month, pushing a buying streak toward the 2-year mark as bullion prices built support above $4,000 an ounce. The holdings rose by 640,000 ounces, or about 20 tons in July, marking the 21st consecutive month of accumulation, data from the People's Bank of China showed on Friday. That was the biggest increase in holdings since October of 2023 and followed the addition of about 15 tons to the reserves in June. All right, so interesting things here to note. Number one, this is PBOC data. PBOC data is produced by the Central Bank of China, government-run statistics. You got to put an asterisk next to any data coming out of China, as we also need to put an asterisk next to a lot of government data from the United States. On top of that, this worth pointing out that this PBOC data, this is not coming from the World Gold Council, which we talked about last week, how wildly wrong they were about central bank gold purchases this year. So this is from a different source. This isn't that WGC data. I'm not sure it's from a better source, the Central Bank of China, but at least it's not the source that was so grotesquely wrong recently. So the Chinese buying gold. Also noteworthy, the last time they bought this much gold was October of 2023. All right, that's important because let's look at the chart of the U.S. 10-year. All right, the last time, October of 2023. Okay, this is an ugly chart here. I got to set this to auto. All right, where are you? Oh, son of a gun. You know what? I messed with things. Oh, come on, TradingView. You're messing with me here. Help work with me. All right, well, TradingView is being a jerk this morning. Let's just try refreshing. Okay. We got our daily candles. Now we can zoom all the way out. Okay. October of 2023 was the last time the Chinese bought this much gold. And October of 2023 is also a significant chart on the chart of the U.S. 10-year Treasury yield, which is arguably the most important chart in the world, is the 10-year Treasury. The last time the Chinese bought this much gold was the high in interest rates, and they declined sharply after that, and we entered this long period of consolidation, which it looks like we have broken out of just recently. So are the Chinese telling us interest rates are about to reverse and start heading lower by buying all this gold now? Could be. Could be. I don't think so, but it's at least worth noting whenever I see October of 2023 or the largest since October of 2023, I can't help but notice that coincides with the peak of that chart. All right. That's China and what they're doing with gold. Now let's talk about China and what they're doing with copper. Copper market crunch brews as U.S. and China compete for metal. The copper market is tightening fast with a surge in shipments to the U.S. and rising orders in China, setting the stage for a rally that could take global benchmark prices to all-time highs. Futures in London this week pushed past $14,000 a ton, a ceiling that had only been breached a handful of days this year, and many traders see prices soon surging past a record 14,500 plus level reached briefly during a bout of speculative buying at the end of January. This time around, the upswing has more to do with trade dislocations caused by the gravitational pull of the world's two largest economies. While an unprecedented hoarding of copper on U.S. shores has sped up in anticipation of a tariff decision, traders have been stepping up shipments to China to alleviate tightness there. All right, this sounds an awful lot like the silver market and the gold market of the last 2 years. After Liberation Day and all the speculation about tariffs and gold, and the metal came from London to the United States, and then we had deep backwardation, and then, the tariff decision came and metals wasn't included in the tariffs, and then all that metal started going back to London, draining the COMEX, and then prices went wacky at the end of last year. Well, copper is now going through that. The flows to China come on top of an arbitrage trade that's encouraging cargoes to the U.S. and drove futures on New York's COMEX to a record on Wednesday. That has been going on since last year, but has accelerated to the fastest pace in at least 12 years as traders await a White House decision on whether to extend duties on semi-finished copper products to raw metal. There has been no indication when or whether President Trump plans to announce a decision on tariffs, which have been a core policy tool in his effort to shore up industrial supply chains. The president will be holding a meeting with mining executives on Friday in Washington in a bid to showcase efforts to help spur critical minerals developments and processing, with plans to unveil a handful of deals and memoranda of understanding. Meanwhile, almost every day over the past 2 weeks, batches of 4,000 to 6,000 tons of copper have been removed from the London Metals Exchange network of warehouses, quickening a steady decline that has shrunk the stockpiles backing the world's most liquid copper contracts by more than 40% since May. All right, that is alarming, guys. That is the potential for a supply squeeze when you've got a 40% reduction of LME stockpiles since May. All right, that means copper prices could be about to go vertical up in a straight line. A lot of that metal, particularly from facilities in Taiwan and South Korea, has been making its way to China, according to traders, warehouse operators, and fabricators familiar with the flows. That's according to them. Outflows have also been seen in LME warehouses in the U.S. as traders have taken advantage of higher COMEX prices. All right, so the U.S. and China are arm wrestling for copper, both combined draining London. And that is what gives you a chart like this. Over the last year or so, the price of copper has ripped considerably, now hovering around near all-time highs. All right, so that's copper, big industrial metal, an important one, an indicator of the health of the economy. But then how do you rectify that with this? Key China steel price hits near decade low on construction slump. Right, this is something we've been talking about for years, the slump in construction in China. This makes sense. But if they're not using steel in buildings, why are they using so much copper? The price of a key Chinese steel product has dropped to the lowest in almost a decade as a prolonged property downturn sapped construction demand and swelled inventories. Spot rebar fell for a 49th straight day to 3,142 yuan or $462 a ton on Friday, the lowest since November of 2016, according to regional prices. Since when has anything gotten cheaper since 2016? Freaking anything. Good God. Let's see. Reinforcement bar, or rebar, is a crucial gauge of China's traditional steel market because of its widespread use in real estate and infrastructure projects. The Chinese property market remains in doldrums, said Sabrin Chowdhury, commodities analyst head at BMI. It's a unit of Fitch. The July Politburo meeting offered no reprieve for ferrous metal markets as the government showed increasing signs of tolerance toward a lower economic growth trajectory, meaning the government didn't push any big stimmies at their meeting in July that disappointed markets. China uses about half of the world's steel, but demand has remained weak as a prolonged construction slump is weighing on the biggest source of consumption. Home sales in the world's second biggest economy may continue to decline in the third quarter this year, Morgan Stanley said last month. Rebar inventories at steel markets steel makers tracked by China Iron and Steel Association climbed to 4.2 million tons as of July 31st. That's up 9% over the previous month, reinforcing signs that consumption is failing to keep pace with supply. A 9% jump in inventory in 1 month is huge for something like steel rebar. And while we have heard that mills have shifted production towards other steel products and away from rebar over the years, it appears that the speed of this adjustment is lagging, said Florence Sun, commodity strategist at Macquarie. All right, so they're making less rebar, and yet rebar prices are down because inventories are up 9%. Now, guys, keep in mind, we've been speculating about possibly this big demand signal that the market is overlooking as we've been watching the oil market scratching our heads. Why are oil prices so low given what's going on in the rest of the world? I've been speculating that maybe the world is missing a big decline in demand in China as possible reason why the Chinese have imported so much less oil over the last few years. I'm sure they've been dumping reserves also. but maybe we've been missing a big demand signal. And look, this decline in the price of steel in China would support that. If you're using less steel, then you're almost certainly using less oil. Maybe that's at least partially contributing to why oil prices are stuck in the dirt here. And again, oil and steel, copper and steel moving in opposite directions. You shouldn't really see that. All right, back to the real estate market domestically. Ashiba's mortgage firm suffers record drop on dividend halt. This story broke yesterday. Shares in United Wholesale Mortgage fell by as much as 49% on Thursday, a record slide after the country's biggest mortgage lender announced a net loss of $452 million and suspended its dividend for the first time. The company announced a $2.05 billion equity capital investment by Oak Tree Capital Management and SFS Capital Group. That's a new investment vehicle owned by Matt Ishibia, UWM's chief executive officer, and his family. All right, so this company, this mortgage company, lost almost $500 million in this most recent quarter. They canceled their dividend, and now you got $2 billion is being pumped back into this company by Oak Tree Capital Management and the company's CEO, putting his own money back in there. He's saying we're taking decisive action to make UWM stronger, more liquid, and better positioned to win for years to come, blah, 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 corporate talking points. United Wholesale Mortgage grew rapidly during the pandemic when lockdowns and low interest rates propelled a boom in the housing market. But in recent years, the firm has come under pressure as the housing market and demand for new mortgages has slowed dramatically. Let's see what's going on here. An earlier attempt by Ishibia to bolster UWM fizzled earlier this year after a months-long fight to buy mortgage servicer Two Harbors Investment, an acquisition that would have diversified UWM's revenue stream significantly. Investors voted to accept an all-cash bid from another suitor. Despite the higher headline price of UWM's offer, Two Harbors Management lobbied against it, citing concerns about the value of the stock portion of the deal. The failed merger attempt weighed heavily on UWM's second quarter results, which included its largest ever net loss, driven in part by a $603 million loss on interest rate hedges tied to the anticipated Two Harbors acquisition. The market moved against us, and it's a one-time bet that won't happen again. We feel like our hedging policies are much stronger now. Yeah, now that we lost $600 million, we feel like we're in a much better place. Congratulations on that. Okay, the market moved against us. It won't happen again. I would point out they're pumping $2 billion into this company after a $450 million loss. That would suggest they're expecting more losses. So maybe it's not such an isolated event. So what happened when they tried to buy Two Harbors here? Two Harbors owned a lot of MSRs, or mortgage servicing rights. Basically the people who handle your monthly payments and your escrow and all that other stuff. Those assets tend to do very well in a higher interest rate environment. So what was going on is, because UWM was buying Two Harbors, they were going to own all these MSRs that do really well in a high rate environment. They decided to hedge their bets by taking out some hedges elsewhere that would do well in a low rate environment. That way, you kind of maintain your neutral positioning. Well, then the merger falls through, so they never acquired all those mortgage servicing rights that would do well in higher rates, leaving them only holding the hedges, and rates moved higher. The hedges lost money, so they took a $603 million hit because that merger fell apart. Okay. And now they're saying, don't worry, that was an isolated event, which is why, to make up for that $600 million in losses, we're putting $2 billion into the company. Well, that $2 billion is a lot bigger than the $600 million you just lost. Are you sure this was an isolated event? I don't know. UWM Holdings higher this morning, up by 8% after falling 35% yesterday. So a little bit of a dead cat bounce going on here. The housing market is frozen and the job market is frozen. So a lot of freezing going on. Meanwhile, Turkey, Saudi Arabia, and Pakistan signed joint defense agreement. Guys, battle lines being drawn. That's all I can tell you. Turkey, Saudi Arabia, and Pakistan signed a trilateral defense agreement in Mecca on Friday, establishing a coordinated security posture against the backdrop of the Iran war. Turkish President Erdogan, Saudi Crown Prince bin Salman, and Pakistani Prime Minister Sharif all attended the signing ceremony in person, according to a statement from Pakistan's foreign ministry. Under the trilateral agreement, NATO member Turkey, oil-rich powerhouse Saudi Arabia, and nuclear-armed Pakistan pledged to jointly retaliate to outside threats against any one of them. And there are currently several outside threats against Saudi Arabia, which Turkey and Pakistan have now latched onto. The agreement is intended to strengthen collective deterrence against any act of aggression and stipulates that any armed attack against any one of the three states shall be regarded as an attack against them all, the Pakistani Foreign Ministry said in its statement. It further provides for the enhancement of all aspects of defense cooperation among the three states. All right, so let's just walk this out a little bit here, guys. You got Turkey is now potentially being dragged in via Saudi Arabia to this conflict. All right, let's say Turkish troops roll into Saudi Arabia to defend against Houthi drones. They end up pushing into Yemen. And let's say the Houthis decide to launch some kind of attack against mainland Turkey. Well, Turkey's NATO. Now Turkey could evoke Article 5. And all of a sudden, basically, like a third of the countries in the whole freaking world would have to come to their aid. This could spiral out of control real fast. And again, if you're the Houthis, you got to be looking at this. Or if you're the Iranians, you got to be thinking twice about your next drone fired at Saudi Arabia. I mean, look, neither of these countries has ever hesitated to attack freaking anyone. But I doubt any of them are in a hurry to go to war with Pakistan and Turkey also, especially considering they're already fighting Bahrain, Qatar, Kuwait, Iraq, Jordan, the UAE, Saudi Arabia, the United States, Israel. Did I miss anybody? I don't know. I'm sure a few, but I guess you could add Turkey and Pakistan to that list. World War III. It's gonna be a heck of a war. All right, and to close out the show, we got to talk about what's going on in Japan. There's a lot going on in Japan this morning. This is a big story here, guys. Japan's biggest insurers post $96 billion in bond paper losses. And again, this is a huge quantity here, guys. 4 companies, $96 billion. And we'll go back to another story from about 2 years ago as we do this for some scale and for some context here. Japan's 4 largest life insurers reported that their combined unrealized losses on domestic bonds increased 7% in the 3 months through June, showing the risks to the industry from soaring interest rates. And if this sounds a lot like the bank crisis in 2023 here in the States, that's only because this is pretty much exactly what happened in the bank crisis in 2023 here in the States. Paper losses on bonds held by insurers, including Nippon, swelled to 15.13 trillion yen, or $96 billion, according to the 4 firms' earnings reports for the April-June quarter. All 4, comprising Dai-ichi Life, Sumitomo Life, Meiji Yasuda Life, and of course Nippon, saw increases in unrealized losses. Life insurers generally hold Japanese government bonds and other debt securities to maturity to meet their insurance liabilities. They may have to sell the bonds, though, for payments if customers rush to cancel their policies, potentially weighing on their earnings and investments. And you can see here, this is the pile of unrealized losses at these 4 insurers going all the way back to March of 2024. This problem just keeps getting worse as Japanese interest rates just keep going higher, and they're not going to stop. That's the important thing. These Japanese borrowing costs are going to keep going up because Sanai Takaichi wants to spend even more money. Inflation in Japan keeps getting even worse. That means more bond issuance, more supply. That also means people are going to be selling their bonds, expecting or demanding a higher interest rate in order for locking up their money, pushing the yields even higher, pushing the bond prices even lower. These unrealized losses get bigger and bigger as that happens. The Financial Services Agency said the expansion in unrealized bond losses is affecting financial accounting and liquidity, and it's closely monitoring insurers' investment activity, meaning we're not doing shit about it. That's according to a report by the regulator released in August. Concerns that Prime Minister Sanai Takaichi's administration may boost fiscal spending to support the economy pushed up yields on the 30-year Japanese government bonds to above 4% in May, marking a record high. Those super long securities are primary investment targets for life insurers. The decline in market prices also triggered impairment accounting for some holdings whose market value had fallen more than 50% below their acquisition cost. Nippon Life booked an impairment loss of about 44 billion yen. Meiji recorded 25 billion loss. Yikes. All right. And look, guys, if they're saying Takaichi's spending plans is contributing to this rise in bond yields, which is causing these losses, Take a look at this headline. Japan's defense ministry eyes record 8.9 trillion yen in fiscal 2027 budget request. This one just broke a few minutes ago. So Japan's spending even more money on defense. Yep, World War III is going to be expensive as all get out. But here's the other thing, guys. Remember, $96 billion in paper bond losses from the four biggest insurance companies. So say like $24 billion a piece per company here. I would like to just draw your attention to this story from back in February of 2025. Norinchukin sees $12.6 billion loss in 2024 financial year. It was a little over a year ago, year and a half ago. Everybody was worried about the fourth biggest bank in Japan collapsing because of big losses in foreign bonds, U.S. treasuries. They had expect to lose $12.6 billion in the year up to March 2025. That caused a collapse in confidence in Japanese banks. It didn't result in a bank run. There was a lot of worries it would result in a bank run. Norinchukin managed to avoid that. I would add that they sold their U.S. treasuries and they put that money into collateralized loan obligations, which is even worse in my opinion. Now, the reason why I'm drawing this attention, because Japanese banks, very similar to Japanese insurance companies, this was a $12 billion loss at this one bank. Now we're talking about a $96 billion loss at these four insurance companies. So much bigger losses. And I would also point out, once again, the U.S. 10-year chart, if you look at where we are currently at in the 10-year yield, around 4.6%, well, that is almost exactly where we were in February of last year when Norinchukin started taking all those losses on foreign treasury bonds. So the rise of interest rates causing problems here is the second time we're going back to this 10-year chart. Guys, there's big problems brewing in Japan. These interest rates are going higher. Insurers are basically, they're basically banks. We've had this trend in South Korea of people selling their insurance in order to pile into AI stocks. Let's hope that isn't also happening in Japan, because that would just make things even worse. But you know what? Hey, don't let any of this don't let any of this doomerism stop you from YOLOing into memory stocks that have risen freaking 800%, or maybe leveraged ETFs, single stock levered ETFs, which is just where money goes to die. Note sarcasm in that last point, guys. Yep, it's going to be interesting what's going on in Japan. Anyways, guys, I just want to say thank you very much for having your coffee with the Melonheads. Hey, real quick, let me stop the music. Real quick, for my Patreon members, YouTube members, and Buy Me a Coffee guys, we are moving our weekly Q&A on Zoom to Sunday night at 7 p.m. Eastern Time due to a family commitment that I have to attend today, so it won't be today. But thank you very much, all you guys, for supporting the channel. I'll see you Sunday night. Links down below should you feel so inclined. Now we'll say all that stuff about the like button, about the subscribe button. Yeah, come on back tomorrow. All that good stuff. Thank you guys for sharing your morning with us today. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.